behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Maria Jelescu Dreyfus, who is the co-founder and CEO for Ardinall Investment Management, and I like to say our resident energy sector expert here at BTT. So with that said, Maria, what is the single biggest energy market misconception investors are having right now?
Hi Todd, it's great to be back. It's nice to see you. Let's dive right in. And what a better question to start with. Um, I would say the biggest energy market misconception right now, if I were to think about it with a little bit of a longer term horizon, is the fact that we are in this belief that we can wean off of fossil fuels, a lot quicker than I think it is realistic. And it's not that either one of us wants to hang on to, potentially polluting sources of energy. I would love to have a hydrogen car to, zip around tomorrow, but that's not realistic. So I think the biggest misconception is seeing energy consumption from fossil fuel sources declining into the next decade and into 2050. And I think we're starting to see the early signs of people revisiting their assumptions. Just recently, the IEA revised their projections, right? Like where their consumption was peaking around 2030 and then was starting to come down pretty severely by 2050. In their base case scenario. And now I think that they realize that unfortunately, we're going to have to live with oil and gas a lot longer than we originally thought. So the question is, how can we do that in a more responsible way and in a more sustainable way? So I think that's the biggest misconception when you think about those businesses being priced as, dinosaurs or with very little terminal values, if you will.
So the legacy energy then, big
Mhm.
oil we'll talk about, would you, I mean, it sounds to me that when you start speaking of those companies, would they really need to adjust their entire business model though going forward, especially if the IEA is talking about perhaps an oversupply issue?
The oversupply that we're talking about is probably, I would say, more of a 2026 phenomena, right? So when I was talking about the biggest misconception, I was looking at the IA assumptions that said oil demand is going to go from 100 million barrels a day plus or minus to 70 million barrels a day by 2030. And in their more aggressive scenario, they had it down to 30 million barrels a day.
Wow.
I think that people are realizing right now that flat is probably the most likely scenario, or potentially even, I mean, again, there's so many variables, and you also have to incorporate human innovation, right? Like, can we come up with something structurally different? Is magnetic fusion going to become a reality? So there's a lot of variables in this 2050 forecast, but I think the idea of 100 million barrels a day going to 30, I think that's kind of off the table.
Yeah, I'm gonna have to agree with you there. So how important is it then for legacy companies to start embracing renewable energy into their business plans?
I think it's incumbent on every corporation, every entity to think about doing their business in a more sustainable way. So the question is, how do you think about a scenario in 2050 where whatever the makeup of energy demand is at that point, there will be some oil, there will be some gas, there will sadly still be some coal, hopefully a lot more renewables. How can you position yourself to create the most value for your, shareholders in the case of public companies, or for, for your owners ultimately? And I think that as a legacy oil and gas company, you're going to have to find ways where you can lever that into new vectors, right? Like new verticals, where you're doing things in low carbon fuels, you're using your existing infrastructure and maybe converting it into a lower carbon solution. But I do think it's going to be specific based on everybody's strength and existing infrastructure. So
So,
you could have
oh,
oil companies pivot into oil and gas into wind and solar. And the European oil and gas companies have done that. Now they're kind of pulling back from that, but that's a potential scenario. And for some people it might work, for some people it may not. There's some other oil and gas companies that are going to focus on low carbon fuels. So those are fuels that are created not just from oil or gas molecules, but from used cooking oil, right? From vegetable oil, from all sorts of waste products that we can convert back into something that's molecularly identical to gasoline, and you can put it in your car tank. So I think that there's different ways to win in this long-term race. Carbon capture, right? We've been talking about carbon capture. We've been talking about hydrogen, ammonia, methanol, all these lower carbon solutions. They will each hopefully have their slice. And the question is, given how these different companies look like today, what is the likelihood that they will be able to extract economic rent and have a moat around those businesses in the future?
Right, right. Earlier this week, I had the CEO of Buffalo Biodiesel on, and he was telling me about they're really focused on renewable natural gas for
Mhm.
next year.
Yeah,
What's your thoughts on that area? Because it seems that they are looking to take really just trash waste, food
yeah,
waste,
yeah.
and converting it. That seems like a hot area to be in these days. What do you
It
think, though?
is. It absolutely is. I mean, think about all the methane that comes out of landfills, right? If we could harness that and convert it into renewable natural gas, you win two ways, right? Like you prevent that methane from going into the atmosphere, and then you create natural gas that's renewable as opposed to digging it out of the ground. So it's the question, of course, is economics. So we've been having a fluid, let's say, policy regime around, tax subsidies or incentives for some of these things. So that clearly concerns investors, right? The investors
Hmm.
like certainty. They want to know that if they invest in a project, they're going to get a specific stream of returns. And when policies change and tax benefits get taken away or get changed, that creates a lot of noise and uncertainty. So renewable natural gas from waste from other sources is a wonderful idea. The question is, how can you lower the cost where you're no longer dependent on those policies, on those tax breaks,
Hmm.
make the economic case? And we're getting there because it used to be very expensive to build renewable natural gas plants, and you used to need to rely very heavily on subsidies. As we scale these up, as we learn how to do things cheaper, there could be a scenario where these are, economically viable even without subsidies. But for now, we still need subsidies. The good news is that we're going to need less and less of those subsidies.
So let's turn the page here to the Russia-Ukraine conflict.
Mhm.
Let's say it de-escalates or even ends, which would be great. What is the single biggest energy market price reaction you'd expect?
Oh, that's a tough question, right? Because it's not just Russia at the moment, right? You have to balance what's going on with Russia with what's going on in Iran, what's going on in Venezuela. So everything else staying constant, you assume the Russia-Ukraine war ends, you would think that that's bearish. Well,
Okay,
at the
bearish.
at the same time, yeah, because you're gonna have increased supply, right? Like there is some supply.
Huh.
Ru- Russia's still selling to China, they're selling to India, but there's a lot of constraints around their ability to access the international markets at the moment, right? If the Russia-Ukraine war ends, you could see a scenario where the Russia production starts getting going higher. You're gonna have international companies back in the country, technology. It's interesting. The Russians right now, they no longer have access to the super high-end tools and techniques that the folks like Schlumberger or Halliburton sell. So they have to continue producing with their own existing technology, which is obviously of of lesser quality. So the production has been massively impaired. If you assume that you're going to have the ability to bring back international technology into Russia, that should definitely increase their ability to produce and therefore be bearish oil.
Interesting. So, as you know, markets love to misprice geopolitics, happens all the
Mhm.
time. So, what would you say are the signals out there right now that would tell you that the markets are overpricing risk or even underpricing it?
Well, the markets right now are just very jittery because there's so many moving pieces and everything changes by the minute, right? Venezuela's become very topical at the moment, and you're seeing a lot of pressure that the U.S. is putting on the regime chair on the regime in Venezuela. And what's interesting when you look at the Venezuela um, numbers as an oil producing country. I think they're currently producing, and I might be off by a little bit, roughly 500,000 barrels a day. Venezuela has the highest reserve of oil in the world. They actually have more reserves than Saudi Arabia. They used to
Really?
produce north of 3 million barrels. Yes. It's heavier oil, so it's a little bit more expensive to produce, and it's not as, high quality. You don't get the same premium as, let's say, um, US shale. But at the same time, there's a tremendous potential to take Venezuela back to, where it was many, many years ago. So I think that that's only become very topical in the news in the last month or so, and investors are watching that pretty carefully. Iran is also a wild card. So there's a lot of movement in the oil market, and it's very, very fluid on the supply side. You had mentioned something that I didn't actually respond in the beginning, and you had mentioned the oversupply in 2026. And that is very accurate. We're looking at a market right now where we're going to see a lot of production hitting in 2026 coming from regions like um, you're going to have Guyana, you're going to have international markets, so non-OPEC adding a lot of supply in 2026. And in a world where even if you see a little bit of demand growth, let's say demand grows by 1 million barrels a day, you're looking at potentially 3-4 million of additional oil coming in onto the market in terms of incremental supply. So the question is, on paper, the market looks massively oversupplied in 2026. What will OPEC do? Would they look to take back some of the production increases that they've ramped up this year? Or is there something else geopolitically that could change the balance? But as you look into 2026 right now, the reality is that we're going to head into a very, very oversupplied situation. Um,
Okay, so let's go back to the
yeah.
Venezuela
Mhm.
conversation. So you're talking about a 500,000 barrels of oil a day that they're producing. Humans right now, and you correct me if I'm wrong, I believe I saw that humans are consuming 87 million barrels a day. Does that sound accurate?
107-ish is roughly,
Oh,
or a little bit of over 100, yeah.
well, I will have to yell at my research team on that one. So, so with that said, though, with the 500,000 barrels, stupid question, the U.S. isn't getting those barrels, correct?
We do have some heavy oil. So the tricky part about the way that the US refining system is set up is that we are set up to take heavy crude, right?
Yes.
So crude that has that is a lot more viscous, has different characteristics, and those usually come from Canada, the Canadian oil sands, from Venezuela. Mexico has some heavy crude, and our refiners are optimized to take that. So there's a lot of swapping that takes place around the world, but the way that the US is set up, especially around the Gulf Coast, is to take in that heavy oil. But of course, oil is fungible, but we in general are better off in the US by taking in these heavier crudes that come at a discount, and that allows our refiners to optimize what's called their slates and allow basically to produce gasoline and diesel at the cheapest possible price.
So, and you're right, the heavy sour crude, we're refining it. That makes a lot of sense. There's also different variations of petroleum in the country, as you know. So, depending on where the oil is coming from, the byproduct of it. So, in Venezuela, though, where's the oil going if they're producing a 500,000 barrels a day?
Well, there's some internal consumption, and then it's going around the world markets. I'm sure some of it is making its way to Asia, and you have a lot of trading houses that are they're working to place that volume. But the point that I was making is that right now they are at the historically low production volume and coming off of 3 million barrels a day, I don't know, like a decade plus ago.
Hmm.
So, or even longer, but there is tremendous potential. The resource there is enormous. It's vast. As I was telling you, it's actually greater than what Saudi Arabia had.
Saudi Arabia.
So, with new technology, with international companies going in there, that is probably the area where you could have the biggest increase if you take, let's say, a 5-year time horizon.
Okay. So if there is a conflict with the United States and Venezuela, how will that impact crude oil prices?
So what the administration is trying to do, what the U.S. administration is trying to change the Maduro regime and allow for foreign investment into the country, right? So
Okay.
in that scenario, you'd be able to open up the energy sector of Venezuela, which has been deprived of foreign technology and foreign capital for the first time in many, many years, and allow the market to develop and grow.
So, okay,
So
therefore,
there is crude, right? Like more crude on the market. There is potential
bearish
to
crude.
bring more crude on the market from Venezuela. It's not going to happen overnight, that's for sure. But the potential is there. The reserves in the ground are there. And it's just a geopolitical situation where if you give US or international European companies, any international company, the ability to go and produce from their vast reserves, it would be, like a kid's dream. Any oil company would be, looking at this as an incredible opportunity because the oil is there, it's well known, it's well mapped and defined. It's just a matter of producing it.
Okay. So the final question then, going into 2026,
Mhm.
oil, what do you think? I mean, is this a sector that investors should probably, I mean, you're looking at it like a utility, just collect the dividends, or do you see actual growth that's going to happen within that industry?
I would not look at it as a utility. I think it's going to be super volatile and not for the faint of heart. So there's so many things that could take it in one direction versus the other, right? You could have a big disruption in terms of supply. You could have geopolitical changes. The way the market is set up right now, what's really interesting is actually everybody looks at the same numbers, right? Like we're looking at a situation next year where we're going to have significantly more supply on the market than the demand will increase by. And right now, another wild card in the market is the fact that China has been buying oil at, what is currently fairly depressed levels, right, to boost up their strategic petroleum reserve. So the question is, will China continue at the same pace, or will they stop buying crude, which obviously would be massively bearish? Uh,
Well, what are your thoughts? What do you think?
I don't have a view on that. I mean, it's anybody's guess, right, as to what China's going to do. But the point is that there's a lot of volatility around the potential different outcomes. But what's interesting, Todd, is that everybody sees the oversupply in 2026. Everybody is very, very bearish. And I can't find one single person who is bullish on the sector in terms of not just crude prices, but even stock prices, right? Like energy stock prices. And sometimes it actually pays to be a contrarian, right? Like when everybody's so bearish on the market, it means that it's to some extent pretty priced in. And what's also really interesting is that we're seeing now, which is a change from years past, a curve that is in contango. It's no longer backwardated. And usually stocks trade with the back end of the curve and not the front end, right? Like the front end varies with all the short-term geopolitical changes or any short-term supply-demand disruptions. But the long end of the curve is what investors and traders and market participants think is the more stable equilibrium type price level. And that is, coming up a little bit, and it's in contango versus historically in the past, it used to be in backwardation. So it's a long way of saying that when you speak to corporates, when you speak to investors, when you speak to everybody from, Houston to New York to London to Singapore, everybody's very bearish crude. So to me, that is a sign that it might be interesting to look at some opportunities and take that contrarian view.
Yeah, I agree with that. That's great advice as
And,
well.
and frankly, historically, I feel like every single time consensus was very, very strongly heading in one direction, the opposite happens.
Yeah, always happens, right? Always happens that way. That's great. Well, that is wonderful advice. I know the audience will get a lot out of that. Maria, you always say when you bring it, you always bring the A game. I want to thank you for joining me today. I can't wait to have you back in the new year so we can continue this conversation.
Well, I look forward to being back, and let's see what the markets bring. In the meantime, I wish you and everyone else a very happy holiday season.
Likewise, Maria. Thank you so much. So, on behalf of Maria Jelescu Dreyfus, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up on Friday, live, Jim Bianco at 11 a.m. Eastern. Definitely want to hear what he has to say. He's going to give us a preview of the Fed meeting that's coming up next week. So, until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.